that made extraordinary items kind of easy, didn't it? Yeah, never happened. Yeah.
But let's say it's one of these problems, are we still going to calculate it?
What would you do with it if you had extraordinary items? You know, you got a question like that. What would you do with it? But assuming this is gave you one. That gave that told them. What is there such a thing? They give you the same circumstances that would have been an extraordinary item before. What is it? It's not operating, just like it was unusual ordering frequency on both, right? So you just plug it in that you're not operating before tax, right? And that's it. So it's like, it's either unusual or frequency. So we do still have discontinued operations, right? They still have that category down in half, that's the same. Right? Tough to mess with it. Okay. So did you guys do some problems? Oh, guess what? I didn't use the test rate. I did do the, I didn't do the shot. I did the 211 ones, so now I'm going to try to get the 101s done, and you guys are last. That's your experience. You know, you're not going to panic.
Rather have misery now or put it off.
Yeah, you know, you're going to study it anyway, you know, it's not, it's not the same animal. Richard Schrader always used to say he hated to teach the 101 and 211 students because they weren't motivated. I say I really prefer them because they're not motivated. It's all about getting them motivated to do it. With you guys, it's kind of boring. You just do it anyway, you know. But it's nice to see you too. It doesn't mean I don't like you. Just, you know, you're just boring. That's all. Yeah. So, anyway, what do you want to do today? You got some problems that you tried to work that you could maybe stumble through from chapter 22. Some good stuff. There's some good problems in there, aren't there?
So this is just a question on double declining balance. You don't take out the salvage value again?
Typically on double declining balance, you wouldn't take out the salvage value because you just let it fall wherever it does.
Okay.
If you do take out the salvage value, which you can do, you can set a salvage value, but you make sure your salvage value is big enough, right, that you reach it before you're the end of the line.
Okay.
Because otherwise you never get to it, right? So then when you do get to it, then that last year you would only depreciate up to that point. You wouldn't do anything that might have been over that. Does that make sense? But then remember what you do when you're doing double declining balances. If you want, you can switch to straight line when straight line is more than double declining balance would have been. Does that make sense? When you get down there. Yeah, well, after you do a few years, in the later years, you could switch. You remember doing that?
Yeah, that's kind of a couple of
years. Yeah, so you could switch over, right, at that point, you know, and split it for the last couple of years. That's basically what it comes to. Yeah, so you've done a variety of ways. Yeah, I prefer not to do a salary value at all. I do a double declining balance. Just let the one fall that does. You know, you're taking 40% a year. You know, the remaining balance, so a pretty big chunk of that. Yeah. Is there a problem with doing that?
Well, there's a couple of them, and I just that instinct, I'd take the salvage value out before calculate depreciation.
Yeah, and then you calculate this normally with double declining balance, and you know, yeah.
So my math is off. I figure it out.
What do you guys want to do? We're going to look at. You don't have your date on this, right? You can see on page 1345 that under International Financial Reporting Standards, they permit the IFRS 8 generally requires retrospective application of prior years for accounting changes. However, it permits prospective method if a company cannot reasonably determine the amounts to which to restate in prior periods, right? And the FASB is basically the same. What does the FASB have where you don't have to use the retrospective approach? When would you not use the retrospective approach for a change? Here on page 1345. If what? What do they say? There are exceptions to it where you can get away from it if you want. You don't have to do it. You know, if you have a good reason. What is a good reason? sounds like what IFRS says, you can't reasonably determine the amounts. Ours says it's not, what is the word they use? Practical, based on practical. So do it. On page 1345, the FASB requires that companies use the retrospective approach, right? Of those three that are possible, we have a cumulative, retrospective, and prospectively. By the way, why does the author give you this theoretical stuff built into it? You know, we could do a cumulative effect all at once, right? Advantages, disadvantages of that. We could do retrospective application, or we could do prospectively, going into the future, of course, right? You know, why would we not do currently? It all hits the current year, right? Too much hit all at once. We talked about that last time. Why would you not do prospectively out into the future? Because it really relates to the past. It doesn't make any sense. So they say we want to do retrospective, but when would you be able to not do that? When it's not practical to come up with numbers, right? That's basically it. So you still have an out. And that sounds an awful lot to me like what the IFRS is. I say the FASB requires that basically the same. If you can't estimate it, you know, then you're not going to have to do it still. Okay. So. You guys work a few of these? Crank through a couple? They're easy. Not overstate that.
It's better than what we've been doing.
Yeah. We talked about direct and indirect effects last time, right? The IFRS does not address that, so, you know. There it is, over on page 1356. Impracticability. Impracticability. Okay, that's what I was thinking of. Okay? What's the deal with that? And a show disclosure of it at the bottom of the page. We're taking a look at it. It's not always possible for companies to determine how they would have imported prior period financial information, right? Okay? How they would have reported prior period financial information under retrospective application for accounting principle change. The retrospective application is considered impracticable if a company cannot determine the prior period effects using every reasonable effort to do so. Companies should not use retrospective application if one of the following conditions exists. They can't determine the effects of it. Well, that sounds just like they had for IFRS. Retrospective requires assumptions about management's intent in a prior period, and you don't know what the management's intent was. Retrospective application requires significant estimates for a prior period, and the company cannot objectively verify the necessary information. Okay, so if above conditions exist, it is deemed impracticable to apply the retrospective approach. In this case, the company prospectively applies the new accounting principle. So we could do that, and they give an example for Quaker Oats down there. They basically just say that if they couldn't do it, but I believe. Actually, that looks more like they actually did one, doesn't it?
Third sentence.
Third sentence says they couldn't find it. Yeah. Okay. So they're going. Yeah. Okay. So here it is. Okay. So any question you want to get on this? Any more problems? We could talk about changes in accounting estimates. We give you a bunch of examples. We talked last time about what's the difference between a change in principle, change in estimate, change in entity, right? And a prior period adjustment should be a correction of an error. Yeah, you get lots of questions on that. Change in principle means what? Two things could have happened. You're using one acceptable gap and you switch to another acceptable gap, right, guys? Okay. What's the other possibility? For the new FASB, right? New accounting pronouncement that changes gap. So then it changes for everybody. You still follow the same rules, right? Okay. And unless the FASB tells you to do something differently, you would follow these rules, okay? Procedures. So how do you handle the changes in the accounting principle? Restate all the years you're showing, right? adjust, obviously do it in the current year too, right, new principle. Adjust beginning retained earnings, right, to the cumulative effect, and disclose in the notes the change, right, and the impact of the change, okay? So what would you do with the change in estimate? Okay, it's going to be in the current year and prospectively in the future, and what's the rationale for that? You made an estimate, you made the best estimate you could in the first place. With all the information you had, you made your best estimate, so you did not make a mistake, right? And therefore, got a new estimate. The thing that causes the change to the statements was the new estimate, right? So that should be in the current year and prospectively into the future. So if I shorten the lives or extend the lives of an asset, you would do that, right? If you change your warranty liability, if you change your allowance for doubtful accounts, you would do that, right? Those types of things, okay? So would you disclose that in the notes of the financial statement? Only if it's extremely material, right? By the way, with any of these, what if it's not material? I don't do anything, right? Don't disclose it at all. Don't have to make any investments to retain earnings. It's not material, okay? All right. So with the change in estimate, will there be a change to retain earnings? Obviously not, right? How about if it's a correction of an error? Correction of an error, what would you do? I made an error 1 year. And then what do? All the revenue expense accounts, gains and losses got closed to retained earnings, right? So now what? I'm going to have to adjust retained earnings for whatever those were. Always remember to pick up what? The tax effect of that, right? Anytime you adjust retained earnings or you adjust discontinued operations, right? Okay? What are you going to want to do? You're going to want to pick up the tax effect, right? Of that change. Okay? How about an cumulative effect of the accounting change? Is there a tax impact on deferred income taxes? Yep. Yeah, you want to pick that up too, right? Okay? To the extent that it affects taxes, right? It affects your incomes. Okay? So you want to pick that up in it too. Because anytime you're going to retain earnings, you want to pick it up. Okay? All right, let's see. What about change in entity? What do you do with that? Just disclose the change in entity, right? And make sure that you restate all of the years. So I used to have the parent and 4 subsidiaries, and you got rid of one of the subsidiaries now. You have the parent and 3 subsidiaries. So what do you need to do? All the years that are shown, so if it's a public company, you're showing 3 years income statements, restate all 3 as though there had only been the parent and 3 subsidiaries each of the years. That makes sense? Okay? You disclose that in a note too that you did that, of course, because it was different than the previous statements, right? But is there any adjustment to retained earnings or to anything? No, right? It's a lot of work though to do this, of course. But why would you want to do something like that? So it's comparable period to period to period to period, right? So you're looking at the same market basket of companies, okay? So changes in entities would apply. Anyway, the examples they give you on changes in accounting estimates, uncollectible receivables, I mentioned that one, bad debt expense allowance, right? Inventory obsolescence, we should have written the inventory down before, but we didn't. With hindsight, in 2020, we know that it wasn't worth as much, so we didn't like our estimate before, so now we're having to adjust the estimate, but still, no prior period adjustment, right? It's not a correction of an error. Unless, how would you tell a correction of an error from a change in estimate? It's way off, and with the knowledge that you had at the time, the information that was available to you at the time, somehow you screwed up and didn't use that information, made it bad, right? So you should have known the inventory was obsolete last year. The evidence was there. You didn't realize it, so you didn't write it down last year. Now you want to write it down this year. What's that? It's correction of an error. What if you made an estimate of obsolescence last year and all the information you had available, you used it and you made your estimate? Now this year you realize, gee, there was a lot more obsolete than I thought. You know, by the way, each year that goes by, you realize it's more and more obsolete. Yeah. Allowance for doubtful accounts, each year that goes by, you realize there's more and more probability you won't collect a receivable if more time goes by. Yeah. So the fact that time goes by changes your estimates too, of course, right? Okay. On warranties, you get a pretty good idea. You know, with your warranty, repair bill is gonna be each year that goes by. You know, it's gonna be higher or lower each year that goes by over the term of the warranty, right? Because the asset that your warranty is getting old, and you're incurring costs on it or not. So, yeah. So, all right, so you talk about perspective there.
Can we do sample 23-21?
Sure.
Can we do exercise?
Exercise 22-21, sure, let's do one. Two, 22-20, oh, exercise, 22-20. The error analysis, okay. When the records of Deborah Hanson were reviewed at the close of 2015, the errors listed below were discovered. For each item indicated by a check mark in the appropriate column, whether the error resulted in an overstatement, an understatement, or had no effect on net income for the years 2014 to 2015. Okay, so 14 and 15 we want to look at. Overstatement, understatement, no effect. Huh. Okay. Failure to record amortization of a patent in 2015. What would that do to 2014? I think no effect all the way, don't you? That's what I'd do. If we failed to record amortization, what would the journal entry be to record the amortization? So you debit amortization expense. Did you have the right one up here? No. Yeah. Everything across the top. So the way we're going to get that is clicking on this thing.
Yes.
Okay. All right. See if I remember that big error. Okay. Anyway, so at least I got the recording sound going right. Still pictures. Good. Anyway, what would be the journal entry for doing this? I kind of like to do it that way. I just like to write down what the journal entry is and then think about it. Then you got all your debits and credits in front. What would be the journal entry in 2015 for that? Debit what? Amortization expense. And credit some sort of a intangible asset. Everybody agree? I don't know what it is, but it's an asset. Okay, they didn't even give us an amount, did they? Okay, but what would that do? I guess your expenses would be, in fact, remember when I did this in principles? Still works. Balance sheet income statement. The impact of that entry would have made expenses higher, net income less, equity less, intangible assets less, right? So if you fail to do it, that's what it would have done. If you fail to do it, what do you have? Over, no effect, no entry there, no effect, right? Over, you guys hear that? That thing. Okay, this is no effect. This one is under, this one is over. Was that the answers they had?
You said over 10.
Yeah, expenses understated, net income overstated. Okay, yeah, they only had net income. Okay, but yeah, I mean, you could have done the whole thing. That's the way I like to set them up. I can't screw anything up. I get all my directions right. Okay. Number 2, failure to record the correct amount of ending 2014 inventory. The amount was understated because of an error in calculation. Okay, so all these are errors, right? Which, by the way, would be prior period adjustments to the material, right? But let's think about that. Where would that be close to amortization expense? Retained earnings. So what would you have to do retained earnings the next year to fix it? Debit retained earnings. If it has a tax impact, what are you going to have to do? If you're increasing expense, you're reducing income, what would happen to your taxes? Well, what would be the tax effect in the year? Let's do the tax effect before we move on. What would let's say this is $100,000, right? And let's say they're in a 30% tax bracket. What would be the tax impact of putting this in 2015 if you had put it in 2015? Yeah, but what? I'd have more expense, less taxable income, right, assuming it's taxable, right, has a tax impact, okay? I have less income, less tax, more expense, less income, less tax, everybody agree? Journal entry to fix the taxes. It'd be $30,000 if I'm in a 30% bracket, okay? Assume 30% tax rate. What do you think? Debit what? Credit what?
Debit tax payable,
Sure, because I owe less taxes. Excellent.
credit tax expense.
Got
Or deferred.
Yeah, it might be deferred income tax payable or tax payable, depending on when we're gonna pay it, right? Okay? It might be a tax refund, right? We're going back, but probably reduction of tax payable for the current year, probably. If it'd been last year, it would have just been tax payable, yeah. But if we're doing a retained earnings adjustment, it might be deferred. Okay, 30 and 30, right? Tax expense, sure. Now think about if you're doing a prior period adjustment. We've closed the books. What would we have closed? This one would have been closed, right? And this one would have been closed. Everybody good? So if none of this has been recorded and the next year I want to record it, what's it going to be? That's the prior period adjustment, right? What would it be? Give me the prior period adjustment to do this. What accounts are screwed up if I never recorded this? Let's see, intangible assets are too high by 100. I credit them for 100. Wouldn't you guys? Okay, and I think taxes payable are too high by 30. I think I debit taxes payable or deferred taxes payable, whichever one it is, okay? Then what would I do? The tax expense and the amortization expense both would have run through what? They'd be in retained earnings. So I have 70 to retained earnings. So I think what I do is tax payable debit for 30, intangible asset credit for 100, and a debit to what? Retained earnings for 70. You just net them out. That's all that happens. That's going to be true with any of these, right? There's a nice one, I guess, to do a prior period adjustment. If you can cut it through to the journal entries, it gets real simple, doesn't it? But just be sure, be sure and pick up everything that would have been close to the expense, and then also, or revenue. And then be sure to pick up the income taxes, of course, right? A lot of times what students will do is they'll just give you this entry and just forget about this. Well, if it says that what the tax rate isn't a problem, guess what? And they give it to you, right? A little reminder that, hey, that's you pick that up. Let's try the second one. Failure to record the correct amount for the ending inventory. The amount was understated because of an error in calculation. These are kind of fun. What do you do with that one? Actually, let's not do that. Am I not supposed to use those and use it? No, it's part of it now, right?
Yeah, so that one's in that
I
program.
can't get to it.
Yeah, that's confusing.
All right, I can add a page and keep that one, which I don't know, we're not gonna go back to it probably anyway, but it led to. Okay, good, so it's got that. So anyway, where does this go? What I kind of like to do is say, well, how does this affect? Obviously a lot of ways you can do this. But what gets affected here, you guys? Inventory is an asset, cost of goods sold is a expense, right? Okay, so what do we have? When we calculate our cost of goods sold, what do? Beginning inventory plus purchases, right? Is available, nice spelling there. Okay, less the ending inventory is gonna be my cost of goods sold every time, right? And I like to write it down like this, a little cost of goods sold schedule, because then I don't get confused at the beginning and the ending so much, right? We know beginning adds, ending subtracts, right? It has the opposite impact. So remember that was hard? Okay, anyway, so what we have was merchandise, not long ago, huh? Merchandise was also omitted from ending inventory. Okay, so failure to record failure to record the correct amount in ending inventory. The amount was understated, okay? So we understated the ending. So I guess what you'd assume is this is okay, this is okay, this is okay. That one's too low. You subtract too small a number, what happens? Cost of goods sold is too high, which of course is the expense that is too high, right? I guess revenue's okay, don't you suppose, right? So that would make my net income too low, which makes my equity too low. My liabilities are probably okay. And what happens to assets? Well, it was too low. That's this one, right? I know everything. Just answer questions. Right? Why do you think it was hard? It's easy, isn't it? Yeah. Right. Yeah. Right. Okay. But I think it's kind of nice to write stuff down. This is the way I work, right? If I try to do stuff like this in my head, I switch them around too much. Especially when you get to this next one. Failure to record merchandise purchased in 2014. Merchandise was also admitted to the ending inventory in 2014, but was not yet sold. Oh my gosh. Okay. So what do you want to do with this thing? Same side. I think I do it exactly the same way. All right. Okay. You can set this up any way you want, or not, doing it ahead of time. Cost of goods sold. Beginning, purchases, only now we have purchases screwed up, don't we? Okay. Available. That's ending inventory. And we'll get some cost of goods. Okay, what's wrong?
Purchases of too low.
Okay, this is too low. How much was it? Doesn't say? Okay, which makes if the beginning's okay, I guess, that makes the available too low, doesn't it? Okay, and then ending is what? They say they did.
It's just too low. So it was also minutes or minutes.
Okay, they leave exactly the same amount out? Or does it imply it's the same amount?
This was also admitted.
Oh, okay, so it's the same amount, so we don't care what the amount is anyway. Right? Because if you fail to put it in and then you fail to subtract it, what happened to your cost of goods sold? This is too low, then you fail to take enough out by exactly the same amount. What happened to your cost of goods sold? Nothing. It's the right amount, isn't it? You guys agree with that? What happened here? What are they missing? What would be the journal entries to fix this? We need a debit to purchases, don't we? And a credit to what?
So is this kind of like a counterbalancing?
Yeah, the errors are offsetting each other, absolutely. So what's the deal here? My cost of goods sold is okay, but other things are still wrong. Something's still wrong, guys. What's wrong? I think my revenues are okay too. They didn't sell it yet, did they?
Wasn't sold.
They treated it sold or not sold?
Not sold.
They didn't sell it, so my revenues are probably okay. My expenses are okay because the cost of goods are okay, and net income is okay. That means this is okay. Wait a minute. Oh, ending inventory is too low. You didn't record it, right, guys? It's true, isn't it? So these kind of play, I don't know, game with your head a little bit. This is too low. Everybody agree with that? They didn't count it, right? And, oh,
Yeah, it's also.
it's debit purchases and credit what, everybody? Not sales. Accounts payable, yes, there we go, all right. It's too easy, isn't it? Okay. All right, that's what's wrong. Ta-da, we're brilliant people. Okay? That makes sense? Yeah. Write down everything you know. They should have debited purchase and credit accounts payable for that one, right? Whatever the amount is. It'd make it a little harder if they gave you the amounts, wouldn't it? They said, oh, well, we didn't record a purchase of $100,000 and then, you know, we understated our inventory by 50,000, right? That's rare. Okay. You make it a little more complex. So would that answer all the questions there?
Would there be an effect for that one, adjusting for 2015 then, when you go back to 6?
Okay, so that was 2014.
Yeah.
Yeah. Okay, so if we were, by the way, would we make an entry to fix this thing? If we found out about it at 14, sure, we'd have a purchase and credit accounts payable. Do we have a prior period adjustment because of this thing? No. What about 2015 though? That's a good point. What happens? Let's do 2015. What happens? My ending inventory was too low, right? okay, which makes my beginning inventory the next year too low, right? So what would I have to do the next year? What would happen to me the next year? If I don't discover this, what's gonna happen to me? My beginning will be too low, my purchase will be correct, my available will be too low. If my ending inventory is correct, what's gonna happen to my cost of goods sold? It's too low. But what's gonna happen the whole time? By the way, I ripped my arrow backwards, you guys, you notice that? Well, too low, of course. But what's gonna happen? Where am I gonna find it the next year? Where would you find it the next year? Somebody's gonna ask you to pay that liability that you have not recorded, right? And then you're gonna realize you didn't record the purchase, right? So when would you record the purchase? You're not gonna be required to create adjustment for it. Recorded as a current year purchase. Start with with too low a beginning inventory, so when we roll this to the next year, right? We roll this to the next year, this comes up here, the beginning inventory is too low, right? And so you just make your purchases too high by the same amount, and you'd be perfect, and then perfect here and perfect. Are you happy with that? No, because you still want to tell what the correct beginning inventory is, right? Okay, you still have your inventory screwed up here, so how would you fix that? That's interesting, isn't it? I want to fix the beginning inventory. But the beginning inventory is going to flow through to the ending, isn't it? If I'm already at the end of the next year, it's self-corrected, hasn't it? That's that self-correcting deal, okay? It's already gone, isn't it? Right? So what would I do with this thing? I've got to get this fixed still, though, don't I? It flows through, but where does it go? What's that?
Debit inventory and credit, or,
Well, we counted the inventory, and we probably adjusted the inventory to the correct amount. If we don't realize it until at the end of the year, we've probably already got the inventory to the correct amount. And what have we adjusted? Cost of goods sold for it. We would have screwed up cost of goods sold. To the extent that you increase your inventory, you've screwed up cost of goods sold, right? We wouldn't record it to more purchases. I wouldn't do that. I would fix the inventory by going through cost of goods sold. Right? Cost of goods sold is going to be too low by that amount. So you debit cost of goods sold and credit accounts payable. It's gone, right? If you'd already gone through the entire period of time, right? Your cost of goods sold would be too low when you calculate because your beginning was too low, your purchases, right, was correct, and then your available would be too low, and your ending's correct, it would make your cost of goods sold too low. Well, you can fix it just by debiting cost of goods sold and crediting liability. The inventory already corrected itself over time, so it rolled through. So yeah, that's a little tougher.
So it would be net income effect also, because your cost of goods sold.
If you never fixed it, yeah. But the problem is the payable, they find you, right? Somebody's gonna ask you to pay that payable. So you find it, as soon as you realize you have a payable that you haven't recorded. I recorded the credit and payable and debit cost of goods sold, because it's already run through cost of goods sold. If it hasn't run through cost of goods sold yet, you can go to inventory. Your inventory is still unreceived, right? Okay, but if you're counting your inventory though, right? If you counted it, you've already fixed it. And if you count it and you don't realize that you failed to record the purchases, see here in this problem, they said, oh, it was left out of the ending inventory, didn't it? Well, more likely it would be included in the inventory. See what I mean? And then what would happen? You have too low of purchases, right? What would be the impact of that? You'd have too low of purchases, right? Too low of available, correct ending inventory, too low of cost of goods sold. And the reason you have too low of cost of goods sold is because you have too low of liabilities. Counted it, right? So too low of cost of goods sold would give you too much income. Your liabilities would be too low, your income would be too high, your equity would be too high. That's a more standard error. And that one's harder to find, right? You'll still find it when you find out that you didn't pay the liability next period. Okay? These are kind of fun. Failure to record accrued interest on notes payable in 2014. That amount was recorded and paid in 2015. So what do you think? Failure to record accrued interest on notes payable in 2014. What does that do? Journal entry for that. What should they have done? Equals. What's a journal do? Fix this, devil what? Anybody?
To record it.
Yeah. What would you have done if you did record it? They failed to do it, what should they have done?
Debit interest expense.
Sure. Debit interest expense, credit interest payable. Okay, then what? That would increase my expenses, reduce my income, reduce my equity, right? And increase my liabilities. That's it, right? That's the impact of that, okay? So if they fail to do it, what's wrong? Understated, no effect, right? Understated, overstated, no effect, understated, overstated, right? Something like that. Okay, sure. Okay, that'd be in the first year. If you realize it at the end of the year, you get prior period adjustment, what would it be? It's an easy one. What's the prior period adjustment for the next year, assuming this is the year? What'd you do with interest expense at the end of the year? Close the retainer. Okay, so what's understated? Retained earnings now, right? Not interest expense. So retained earnings is the equity account, right? Okay, so what would you do? Or overstated, I'm sorry, retained earnings overstated. Expense understated, retained earnings overstated. What would you do to retained earnings? Debit it to reduce it by the amount of the interest expense, and then you still credit interest payable, would you? Right? Got it next year. Okay. If it isn't found, it was recorded and paid in 2015. So what did they do in 2015? They debit interest expense and credit cash, I guess, huh? Or they waited, they debit interest expense and credit interest payable, but then when they paid it, they debit interest payable and credit cash. So it ends up with being debit interest expense and credit interest payable in 2015. So if this is 14, right? What happens in 15? Exactly the same issue, right? Only it's going the other way, isn't it? What happens to you? By the way, is this thing going to correct itself between the 2 years? They recorded the interest expense and they paid the interest, guys. That's all that's happening here, right? It's just in the wrong year, isn't it? So what happens in the second year? Here we go. What's my entry going to be? Debit interest expense and credit interest payable, same thing, or let's make it credit cash. Say it's debit interest expense and credit cash. And remember, they never did record that other one, right? So this one never got in. This one didn't happen, okay? So what does that do? That increases my expenses above what they should be, is that correct? But the credit to cash, I'm okay with that, aren't you? If they paid the cash out, that's fine. I'm fine with that. So what I end up with is my retained earnings was overstated here, right? Now I'm reducing my assets. So if you think about retained earnings, in 2014, they had too much by the amount of that interest expense, huh? But now what they've done is the expense is too high, which makes the net income too low. So for this year, that net income is too low by exactly the same amount. And guess what? Those areas just offset. And so what would be your adjustment at the end of the second year? Nothing, right? What you do if you wanted to restate the years though is what? Go back to 14 and say the income should be less by the interest expense, right? On the income statement. In the following year on the income statement, the interest expense should be less than the net income by more, right? Exactly the same amount, it's just between the 2 years. If you are restating the balance sheet at the end of the previous year, right? At the end of 2014, I'd say my liabilities were understated, I'd add that interest payable to it. My retained earnings is overstated, I reduced retained earnings by it. What would be wrong at the end of the next year? Nothing, they're all okay, the error corrected itself, right? Including retained earnings, wash through retained earnings, okay? So that's that self-correcting aspect, okay? Both years' income is still wrong, right? Everybody got that, okay? You still want to correct it. The fifth one, failure to reflect supplies on hand on a balance sheet at the end of 2014. What does that do? You don't have your supplies on hand on your books. Okay. What is that going to look like?
So supplies, if you will.
Yeah. What would be your journal entry to fix that? They didn't really finish it, did they? Could be a couple of things here. The supplies inventory is too low. Is that what it says? They're not giving you credit for every debit. Fix this, what would you do? What would be the adjusted journal entry to fix it? They failed to put supplies inventory in the balance sheet, right? They need more here, right? This is too low. Debit supplies expense, or inventory, I'm sorry, to fix it, right? And credit what? What?
Payable.
He likes accounts payable. I'm fine with that. Uh-oh. Could be that. What else could it be? Cash, I guess. That's possible. Not as likely because you did a bank reconciliation, you probably find that one, right? But if you have failed to record a payable, that could happen. Okay. If you didn't record a cash disbursement, you can't find it in bank reconciliation. Could be something else. Maybe it's neither one of those. What else could it be, guys? Problem not quick at all. What's the other thing? It's really logical. When I buy my supplies, I don't debit supplies inventory, I debit. Well, no, this is supplies inventory, not merchandise inventory. So what's the expense account? Instead of cost of goods sold or purchase. Purchases in a periodic system, right? Cost of goods sold in a perpetual system, right? Have different accounts because it ends up in cost of goods sold in the income statement either way. But that's merchandise inventory. This is supplies inventory, right? So in supplies inventory, what's it going to be? When it ceases to be supplies inventory, it becomes expense named supplies expense, right? You buy supplies inventory, you put it in the storeroom. Paper supplies, cleaning supplies. You put supplies in the storeroom, you debit supplies inventory. When you take them out, what do? Credit supplies inventory and debit supplies expense. Thank you. Okay, all right. Anyway, sure. So what we could have done, instead of putting everything into supplies inventory in the debit, we go to supplies expense. Remember that stuff? You plug it into supplies expense. So now supplies expense has more in it than we used. So then you count it at the end, and what do? You take it out of supplies expense and put it into supplies inventory. That makes sense? So could we debit supplies inventory and credit supplies expense? Yes. And that is just as likely as debit supplies inventory and credit accounts payable. I don't know what the journal entry is to fix that. So what does this do? What accounts screwed up? Well, it depends. It might be this one plus this one, or it might be this one plus this one. Right, guys? I can't tell. I don't know what the authors intended without looking at their solution. Anybody have a solution from them? Hold it up here. Failure to reflect supplies on hand. I think they must mean that they should debit supplies inventory and credit supplies expense. And that would lead me to believe that what happens, the effect on net income. Otherwise, there's no effect on net income. If it's debit, supplies, inventory, credit accounts payable, or debit, supplies, inventory, credit cash, there's no effect on income there, right? But if it's debit, supplies, inventory, credit, supplies, expense, what would it be? They, expense is too high? Yeah, so it'd be, yeah. So if we make it this, the asset's too low, the expense is too high, net income's too low, which causes equity to be too low, right? If we made it accounts payable, it's assets are too low and liabilities are too low, wouldn't have any impact whatsoever on expense, right? Okay. But if it is a liability, would it have an effect the next year? Yeah. If you don't find out about the liability until later, right? It has to be more than a year later. So again, you'd probably find out about it and correct it. But if we do this, if we make this mistake and we don't find it until the next year, what will happen next year? You don't have enough supplies inventory. So if you think about supplies inventory, if it is too low at the beginning and you add the right amount of purchases and then you go count your ending and it's correct, what just happened to you? Your expense, this is going to be debit, expense, credit, inventory, right? It's going to be what? This is just like merchandise inventory, isn't it? If your beginning is too low, right? Your purchases are okay, your ending is okay, what's wrong with your cost of goods sold? Too low. Well, that in this case would be supplies expense would be too low, right? So between the 2 years, what would happen? We make expense too high in the first year, we make it too low in the second year, right? So it's not correct. And that one too, if you didn't realize it. And could you count the inventory wrong? Yeah. Fail to record the inventory, I guess it's counting it wrong, right? You went ahead and expensed it, then you can put it as an asset, you expensed it. Every expenditure you have is either going to be what? What are the possibilities? If you buy an asset, it's either still an asset at the end or it is now other than land, it turns into what? You don't still have the asset, it becomes an expense, right? True? Okay, pretty much. Okay. That's kind of a neat one. Did you look at the answers or were you more close? What problem number was that?
Exercise.
Exercise 22. This is binding. Now I'll have to find it again. Probably killed it. Yeah. Any exercises yet? Yes. 22-1. Exercise 22. This is what you get for using the Bible. There are way too many problems. It's not designed to have it up on the board like that. 2020, was that it? They didn't tell us anything?
You have to do that one.
22-21, that's it?
22, 26. Because
Okay.
Beyonce.
Oh, Beyonce?
Yeah.
Oh, we didn't do 22, we did 21.
Yeah. But I'm
Okay,
thinking-
yeah, and it doesn't tell us why or anything. The first one, is that what we came up with?
Yep.
Second one, what we came up with, so on. Looks like it doesn't. If they didn't give you any explanation at all, that's not very nice. At least I tried to give you some explanation. Okay. You want to do 22 because it's Beyonce?
Yeah, duh.
Oh, change from fair value to equity.
That's what I get.
Yeah. Why would they do that? Why would you change from fair value to equity? What's wrong with them? I like fair value a lot. Why would they change? Why would they change? Mine. Change what from fair value to equity? What are we accounting for? when you use which method? Now, you guys know this too. Because we told you, you read about it a couple times now. Okay, what is it? Percent that we own and therefore percent of control we have. What are the ranges? We have no control. We have really? I didn't have, not have my hand here. We have, there it goes. No control. And then we have control. Remember these? And then what else do we have in between?
Or significant.
Oh, good. All right. Significant influence. You guys didn't know all this stuff when you sit down and do this. Isn't that cool? You will too. Okay. No control, significant influence. So if you're in percentage rules of thumb.
No control, 0 to 20.
Yeah, usually we think about it that way. When we vote, we lose, right? In the positive vote. Okay. Control. Yeah. Okay. And then in here, basically, in this range, right? Okay. Significant influence. We have a seat at the board of directors table, probably. We don't dismiss stuff in most companies. Depends on the company, so there are rules of thumb. Okay. So what methods of accounting do you use? Mark to market, fair value, right? Fair value, mark to market accounting, right? Okay. In here and in here. What do you do with the ones you control? I think they don't exist because I control them. I combine it with me and I call it a consolidated financial statement. And I have a minority interest in this part I don't control. There's a minority interest in the assets plus the liabilities, right? Minority interest in the equity. It's there. I'll put that in as minority interest. Then on the income statement, I'll show it have the minority interest of earnings, right guys? True. Okay, so the minority interests are separate, and this is consolidated. Okay, good. Little redo. And then here, that's equity. I adjust for my equity interest. Okay? What I say is if I own 30% of the company, 30% of their net income is my net income, right? If I pay dividends, I get 30% of the dividends, but I decided to give myself a dividend. So what am I doing? As I earn here, what do? As they show income, as my affiliated company shows income, the company I have an equity interest in. Let's say they show 100,000 of net income. Go away somewhere else. Okay. Anyway, if I own 30% of it, they show 100,000 net income. My income's 30,000. What do? Debit investment in affiliate for 30,000, right? And credit equity interest in earnings of affiliate, a revenue account, an income account, right? Credit that, right? So it's gonna hit my income statement. Okay, that's the equity method. What do I do when they pay a dividend? Debit cash and credit investment in affiliate. So I increase my investment in affiliate when I buy it, then I increase it when they earn, I reduce it for their losses, my proportionate share, or their earnings or losses, and I reduce it for my proportionate share of their dividends, right? That's equity method. What do you do? Oh, by the way, what do you do if you're consolidating? They don't exist, who cares what you do? You get rid of them. Keep it a cost method. You have to record the dividends you do, right? And then you eliminate it anyway for paying yourself a dividend. You eliminate everything in consolidation. So you can use the equity method if you want when you're going to consolidate, but you have to eliminate everything anyway, right? Because they don't exist. You can't have earnings from them if they don't exist, right? They're part of you. Okay, anyway, if there's no control, though, what do? We go out and find the market value, don't we? What kind of securities do we call these things? Trading securities, I'm going to hold them a real short period of time, but that's not what we're talking about here because we went to equity method. So what do we probably got? Available for sale. How are we keeping track of them? We mark them to market every time. And what do we do with the gains and losses? Where are they at? Where do you put the gains or losses on available for sale securities?
Yeah.
They don't go to the income statement. Where do they go? Oh, yeah, got it. Okay, so we got other comprehensive income, change the market value of the Social Security, right?
A little bit under realized gains and losses.
That's where they're at, the unrealized gains and losses. So if you were to sell a stock, then you have a realized gain or loss, but those would probably be trading securities, not available for sale, right? By definition, you keep it available for sale longer. Okay, so if you sell them, yeah, you have a realized gain or loss, and you record it in the net income. So what are they asking us? All of that to find out what the heck they're asking us here. What do they mean? They bought 25,000 shares, which is a 10% interest, and then what they do over time. Oh my, they bought another 20%. What do they have now? 30%. Where did they go? They went from here to here. What are you going to have to do? Change. Okay, there's a president of our university wandering around out there, and she just yawned. How boring is this to her? Yeah, anyway. You guys know Doris? You ever met Doris, maybe? She is wonderful. Jay was a fun guy, great Elvis impersonation. Did you ever get to see that? Oh, did anybody see it? God, what, did he quit doing it completely? Okay, anyway, so, now he was a great guy. He built a lot of nice buildings, didn't he? So anyway, but Doris is just absolutely wonderful. Just really a good-hearted person. And she was, I understand she was a good education professor at one time. I don't know if Jay ever professed anything, not Jay, but he was not a teacher, put it that way. She was. So, interesting change. So we'll see where things go, how long she's president. Have you noticed any perceptible change in anything? Isn't it funny when leaders disappear, nothing changes? That's another leader comes in, right? So, yeah. But Jay's a good guy. Okay. So what do we do with this thing? What are you going to have to do? It says that how much they paid for it. What account would it probably be in? Available Social Securities. What do you want to do? Take it out and put it into investment affiliate. Are you supposed to? I bet we're going to do that. That I'm at least going to do. And the new stuff that I buy, I probably just directly put in investment affiliate because I'm not going to be over. The fair value of their identifiable assets net of liabilities was equal to their carrying amount. Okay, so the carrying amount's the fair value. So now she owns 30%. And then he reported all this income before in 12/14, which was before the purchase was made, right? And then for the 6 months ended June 30th, and then for the 6 months ended December 31st. Why would it make any difference? Because he didn't have the other 20% until when? July 1st. So we'd probably be accounting for it under, also, under the fair value method, we talked about that you adjust the market value. What else do you do? What if they pay you dividends? You don't vote to take a dividend, you're paying yourself a dividend. Debit cash, credit what? Dividend revenue. It's not dividend revenue anymore now, right? Now I'm paying myself a dividend, so we gotta fix that. Okay? Do I wanna leave the, do I wanna leave the thing at, or what do we do with their earnings, by the way, then? As they earn, they're showing that income. We say yay, right? We record nothing if it's fair value. True? And good stuff coming back. And then what would we do with changing market value? Well, that is, of course, the gain or loss, the unrealized gain or loss, right? Okay. But we're suddenly not going to have any of that. We're going to get rid of it. We're going to take it from fair market value and we're going to adjust it to what? What it would have been had we been equity method all along. Okay? So what is this thing? Is this a correction of an error? No. Is it a changed accounting principle? We were following correct gap before when it was, right, an affiliate. And now we're going to follow fair gap when it's, I'm sorry, when it was an investment available for sale. Now we're going to be an affiliate and we're still going to follow gap, aren't we? So is this a change in accounting principle or is this a change in entity? Right, this is kind of a change in entity, isn't it? Yeah. So what number was this thing?
Just the next four.
Okay, so what do we got? Okay, so what do they have? They say now it's 30% as of 7/1/15 is necessary to first adjust the investment to the equity method in the prior periods, as though they had always been an equity, right, investment, okay, an affiliate, okay? So what's happened in the prior years? Well, they had 10% of their earnings in the past, right, for each period, for 14 and then for half of 15, right? The dividends received, right, were nothing, I guess, okay? Then, so under GAAP, goodwill is not amortized, we know that, okay? A computation of the ending balance of the investment account can now be made as follows. So we've got an investment of $1.4 million, that's the beginning one, right? Which we're gonna take out of available for sale and we're gonna put into investment in affiliate. Okay, we have $3,040,000 for the new purchase, okay? We're gonna add the 70 for the income because that would have been debit investment in affiliate and credit equity interest and income of affiliate, right? Sure, okay? And then adjustment for 2015 up to the date, right, that we purchased a 30% share. So we got another 50 coming in, okay? And then what's gonna happen for the income from this year? Well, that's gonna be debit investment in affiliate and credit income from affiliate, isn't it? But now it's a 30% share instead of a 10% share. That one was a 10, right? That one was a 10. This one here is a 30. And then what about the dividends for this year? That's a reduction of our investment, right? Debit cash and credit investment in affiliate. So they're gonna take that out. So here's their ending investment, okay? And then they didn't give us a journal entry, those turkeys. Okay, what would we do for a journal entry? What do we have in the account right now? Let's see if we can do this. I think we can. Go away. What do we have on our books right now related to this thing? Do it. That worked. Okay, anyway, so. You're resourceful. Did it look like I was doing something wrong there? Okay, all right. Not just me. Push the wrong button. Drives my wife nuts. I keep pushing. She got one of those touch screens. And I'm beating on it. You know, she's like, "You're gonna break it. Stop it. It doesn't work any better. It works worse. Stop it." Yeah. Now I'm using touch screen sometimes. The one that's not a touch screen, I find myself. You guys do that? Touch the ones that, yeah, it's not a touch screen. It just sits there and looks. Okay. What do we want to do here? What do we have in the account right now related to this company?
1.4.
Yeah, we have 1.4 million in there, don't we? And that's in what? Investment in affiliates? I think I want to credit investment in affiliate. What do you guys think? For 1,400,000, is that what that was?
Once you credit the available for sale.
Oh, I'm sorry, investment in available for sale. Thank you. You're right. Absolutely. Already screwed it up. Investment in available for sale. Probably long term, don't you think? Bet it is. And then what do we want to debit? Investment in affiliate. Let's put the investment in affiliate in. Okay. And the company name you probably put on it, sure. All right. How much is that going to be? 4,688,250. Hey, what else do you want to do? Give me some more. It's not too bad, I don't think. It's right there in that adjustment. What do we do? The additional purchase was for something. What do we give them? Assume we gave you cash. Bought the stock for cash, maybe? 3040. You like that? You guys good with that? I mean, it's probably true. Then what else do we have? Adjustment to 2014 income. It says both of those are prior periods, but one of them is the current period and one is the prior period. So 2014 would have been, if we had been using the equity method before, that would have been income that year, wouldn't it? Which would have been close to retainer. So what we'd probably do with that one with the first 70,000. Increase our retained earnings, right? Everybody agree with that? Probably. Okay. Might there be a tax impact of any of this? Depends on, maybe a deferred tax impact, probably wouldn't be, let's leave out taxes for now, okay? Getting too complex, but I think that 50 would be a credit to retained earnings. Okay, what else do we have? What about the 70 for the, it was 70 for prior years, what was the 50? 70 was the prior years. The 50 is part of this year, right? So that's 70, okay. Then the 50 is part of this year, but what else do we have? More income, so this just happened to be when it was 10%, now it's 20%. So how much did we earn this year from it? 2,945. That's debit investment in affiliate and credit what? Income from affiliate, or equity interest and earnings as affiliate, or something like that. For short, income from affiliate. You like that? We got it. We're good, guys. It looked hard and it's not, huh? What's left? 116,250 debit. What did we do when we received that cash? Before we made our purchase. Oh, this is after our purchase, isn't it? What if the dividend had been before we made the purchase? It would have been debit cash and credit dividend revenue, so how would we fix it? Debit dividend revenue and credit investment in affiliate, right? If it come in before. But it's coming in after, so I guess when it comes in and we've already bought the stock, we'll know what to do with it. What would we do? Credit investment in affiliate and debit cash. So I never would have put it in there in the first place. Okay, so I guess we already recorded it before we knew we were going to buy it. Let's pretend we did. And what would we take it out of? You need a debit. How much is it? 116,250. If I'm just getting the cash now, I guess I debit cash, right? Okay, fine, right? Okay, but what am I going to do with this thing? Yeah, so that reduced the investment. So the investment would have been 116 more if we hadn't taken it out, right? So I guess that's reducing dividend revenue. If you already put it in, right, you got to take it back out, or maybe it's just cash coming in now. That's fine too. Okay, it's cash coming in right now, but it's not investment. Point. Is that journal entry balance? Yeah, that's it. So they did have everything for the journal entry, they just didn't write this one. Huh? Okay. Good stuff. Kind of fun. Independent way. It's some singer. What is it with women that are really great singers? They have to wear ridiculous looking outfits, especially when they're attractive in the first place. Who would do that?
Oh, no, we're not yet for them.
Super Bowl she was in or something.
She looks fabulous.
Oh, fabulous. Such a, yeah. It's like you're from outer space or something. I gotta do that. It's not from outer space. Outer space is from, I don't know, Hawaii. Florida, probably from Tommy Bahamas or something. From UPS. Anyway. All right, go away. I got a stupid meeting today from 4:30 to 6:30. 6:45. You get out of it. That's just you go. Yeah. This is my last one. Yeah. They only meet twice a year. It's not that bad. And they're nice people. We're gonna have dinner too.
You can pay me to go.
And eat.
Yeah.
Maybe.
You could get sick in the next hour and a half.
What's that?
You could get sick in the next hour and a half.
Yeah, I could, couldn't I? I am, and after we put on a suit and tie, I'll be sick by the time we're done. All right.
Did you call them? No. I emailed them.
Miranda, what else are you doing today?
Miranda, do you want to be homeless? Do you want to